Two brothers, same parents, same upbringing, same school, same starting salary. At 26 years old, they each received the same inheritance, $15,000. And they made different choices. Not dramatically different, not obviously different, just different. Marcus put his $15,000 into a diversified stock index fund. He set it to reinvest automatically. He never touched it. He never checked it obsessively. He just left it and got on with his life. David took his $15,000 and used it as a deposit on a small rental property in his city. He found a tenant. He managed the property. He dealt with the boiler that broke in year 3. The tenant who left without notice in year 7. The roof repair that cost $4,000 in year 11. He dealt with all of it and got on with his life. Now, 30 years later, both brothers are 56 years old. One of them is worth $1.4 million. One of them is worth $912,000. Both of them made money. Neither of them lost. But the gap between them, $500,000, was not created by luck. It was not created by intelligence. It was created by one question that most people spend their entire financial lives arguing about, without ever running the actual numbers to find out the answer. Real estate or stocks? Which one will make you richer? We ran the numbers. We ran them across 30 years. We ran them across multiple scenarios, multiple market conditions, and multiple investor types. And the answer is not what most people expect. Stay with us, because in the next 13 minutes, you are going to see both sides of this debate run through real mathematics. You are going to understand, for the first time, why this is not actually an either-or question. And you are going to leave this video with more financial clarity on this subject than most people accumulate in a lifetime of opinions. This is the video the internet has been arguing about for decades. Tonight, we settle it. Before we show you who won. Welcome to Finext Wealth. Whether this is your first time here or you have been with us since the beginning, you are in exactly the right place. This channel exists for every person who wants to understand how money actually works. Not the opinion, not the argument, not the social media debate, the actual numbers. Hit subscribe right now and turn on your notifications. And here is something we want you to do right now before the video goes any further. Share this video with one friend. One person you care about who is trying to figure out whether to invest in property or the stock market. Because the answer we are about to give them is the honest, number-backed, emotionally clear answer that most financial influencers are too afraid to give. Because it does not fit neatly on a motivational poster. Invite them in. The more people who understand this, the better every financial conversation gets. Now, back to the two brothers and the 30-year debate that is about to be settled with mathematics. Before we run the numbers, let us establish the rules. Because this comparison only works if it is honest. And most comparisons between real estate and stocks are not honest. They cherry-pick the best decade for whichever side the author is arguing. They ignore taxes. They ignore fees. They ignore the reality of what it actually takes to manage both. We are not doing that. Here are our rules. Rule 1. Same starting capital. $15,000. For both. Rule 2. Same time period. 30 years. For both. Rule 3. We include everything. For stocks, we include dividends reinvested, index fund fees, and capital gains tax on withdrawal. For property, we include the mortgage, maintenance costs, property management fees, vacancy periods, and capital gains tax on sale. Rule 4. We use historical averages. Not the best decade, not the worst decade, the average. Rule 5. We track both the financial return and the human cost. Because money is not the only currency in this equation. And Rule 6. We do not pick a winner until we have run every number. Because the honest answer to which one makes you richer depends entirely on one thing. Not the market, not the decade, not the economy. You. And we will show you exactly what we mean by that. By the time we reach the end of this video, David sits at his kitchen table and writes these rules at the top of a blank notepad. He has been having this argument with Marcus for 30 years. Tonight, they are going to settle it. With numbers. Marcus's story first. Because Marcus made the simpler choice. And simple, as we are about to show you, is significantly underrated. Marcus took his $15,000 in 1994. He invested it in a low-cost S&P 500 index fund. Management fee, 0.03% per year. He added $300 every month from his salary, automatically, before the month had a chance to spend it. And he set every dividend to reinvest automatically. Then he did something that most people underestimate the difficulty of. He did nothing. He watched the market crash in 2000. He did not sell. He watched it crash again in 2008, losing nearly 50% of its value in 12 months. He did not sell. He watched it recover. Saw, pull back, recover again. He did not sell. He just kept adding $300 a month. Every month. For 30 years. Let us run the numbers. Starting capital, $15,000. Monthly contribution, $300. Total personally contributed over 30 years, $123,000. Average annual return of the S&P 500 over the last 30 years, approximately 10.7%. Adjusting for the index fund fee, 10.67%. Marcus's portfolio after 30 years, $1,432,000. Let us say that again. $1.4 million. From $15,300 a month, of which Marcus personally contributed $123,000. The remaining $1,309,000 was generated entirely by compound interest, money that Marcus never earned from a job, money that worked while Marcus slept, money that compounded through 2 market crashes, 3 recessions, and 30 years of news headlines telling people the sky was falling. Marcus never became an expert. He never read a financial analyst report. He never predicted a market move. He just stayed, consistently, in the market, for 30 years. And the market, imperfect, volatile, terrifying in bad years, rewarded his patience with $1.4 million. Now David took his $15,000, the same $15,000, and used it as a deposit on a rental property priced at $150,000 in 1994. Mortgage rate, 7.5%. Standard for the time. Monthly mortgage payment, $1,049. He found a tenant at $1,100 a month. The first year, he was ahead by $51 a month. Not glamorous, but the numbers were not the whole story. Because David's property was doing something Marcus's index fund was not. It was being leveraged. David controlled a $150,000 asset with $15,000. That is a 10-to-1 leverage ratio. And when the property appreciated, it appreciated on the full value of the asset, not just on David's $15,000 deposit. Over 30 years, at the historical average property appreciation rate of 3.8% per year, David's property grew from $150,000 to $482,000. He also collected rental income for 30 years. Average rental yield after expenses and management fees, approximately 4% of property value per year. But wait, here's where David's story gets complicated. The boiler in year 3, $4,000. The tenant who left in year 7, 2 months of lost rental income, $3,000 in repairs to restore the property. The roof in year 11, $7,500. A rate period in year 19 when the property sat empty for 4 months, $15,000 of lost income. Property management fees across 30 years, approximately $6,000 to $7,000. Maintenance, repairs, insurance across 30 years, approximately $9,000 to $4,000. Mortgage payments across 30 years, $307,000 to $7,640. David's net position at year 30. Property value, $482,000. Total rental income received, approximately $291,000. Total costs including mortgage interest, maintenance, management, approximately $558,000. Net return, $215,000. Plus property equity of $482,000. Total financial position, $697,000. After capital gains tax on sale, approximately $912,000, accounting for primary residence exemptions and reinvestment. $912,000. Still extraordinary. Still life-changing. But $500,000 less than Marcus. And significantly more work to get there. Now here is the section that almost every comparison between real estate and stocks leaves out entirely. The human cost. Marcus's 30-year investment journey cost him approximately 4 hours of his life. 1 afternoon to set up the account. 1 hour per year to check the annual statement and confirm nothing needed changing. That is it. He did not receive a call at 11 p.m. about a boiler. He did not spend weekends reviewing lease agreements. He did not negotiate with a tenant who had stopped paying rent. He did not manage a contractor who disappeared halfway through a roof repair. He did not deal with the emotional weight of a property sitting empty, while a mortgage payment went out regardless. David's 30-year investment journey cost him, conservatively, 1,200 hours of active management. His evenings, his weekends, his attention, his stress. His marriage went through a period of significant tension in year 7 when the tenant left. His savings took a hit in year 11 that delayed a family holiday by 2 years. He became, by necessity, a part-time property manager with a full-time job, and he would not entirely trade it because of the lessons he learned, the financial intelligence he built, the tangible, physical asset he can see and touch and pass to his children. Those things have a value that does not appear on a spreadsheet. But when Marcus and David sit down tonight to compare notes, and Marcus pulls out a portfolio statement showing $1.4 million, and David pulls out his property valuation and rental history showing $912,000, David looks at the number, and then he looks at the 1,200 hours, and he says something honest. He says, if I could go back to 26, I would do both. And this, right here, is the real answer to the question. Not stocks, not real estate, both. And the reason most people never arrive at this answer is because the question is framed as a competition. Real estate versus stocks. As if choosing one means rejecting the other. As if your financial future must be built on a single foundation. The wealthiest people in the world do not choose. They build portfolios that contain both. And they use each one for what it is uniquely good at. Stocks are uniquely good at passive compounding with zero management overhead. Liquidity. You can sell a portion of your stock portfolio tomorrow if you need cash. Global diversification. Your index fund owns thousands of companies across dozens of countries. And the lowest possible barrier to entry. You can start with $50. Real estate is uniquely good at leverage, controlling a large asset with a small deposit. Inflation hedging. Property values and rents tend to rise with inflation. Tangibility, a physical asset you can see, improve, and pass to your children. Forced savings, a mortgage that builds equity whether you feel financially disciplined that month or not. And tax advantages that stocks simply do not offer in most jurisdictions. The question is not which one makes you richer. The question is, which one are you ready to start with? And then, as your financial life develops, how do you build both? David and Marcus have been arguing about this for 30 years. Tonight, they finally agree on something. The right investment vehicle is not determined by the market. It is determined by the investor. And there are 4 types. Type 1, the passive builder. You want your money working without your involvement. You do not want phone calls. You do not want management headaches. You want to set something up and let mathematics do the rest. For you, index fund investing is the obvious choice. Set it up, add to it monthly, leave it alone, and let 30 years of compound interest do what it has always done. Type 2, the hands-on creator. You want to build something tangible. You are willing to learn, willing to manage, willing to deal with the complexity. You want an asset you can see, improve, and hand to the next generation. For you, real estate is not just a financial vehicle. It is a project, a craft, an expression of how you build things. And the returns, especially with leverage, can be extraordinary. Type 3, the balanced architect. You want both. Some passive compounding is running quietly in the background. Some tangible assets build equity alongside them. You are willing to manage complexity, but not to be consumed by it. For you, the answer is a portfolio. Start with one. Build the other when you are ready. Never stop adding to both. Type 4, the starter. You are at the beginning. You do not yet have enough for a property deposit. You do not yet have enough confidence to know which type you are. For you, the answer is stocks. Today, with whatever you have. Because starting in the market now, with any amount, puts the most valuable thing in finance to work for you immediately. Time. And time, as Marcus's $1.4 million proves, is the only investment that cannot be replaced once it is gone. The dinner runs long. The restaurant is quieter now. Other tables are emptying. The energy of the evening is winding down. David looks at his notepad, the numbers from 30 years sitting side by side. Marcus's portfolio. David's property. He says, "You won." Marcus shakes his head. He says, "I did not win. I made a choice. You made a different choice. We both built something." David says, "But the gap is $500,000. Marcus says, "Yes. And I spent 1,200 fewer hours getting there." He pauses. He says, "But David, your property is real. I can see it. You can improve it. You can pass it to your children exactly as it is. Mine is numbers on a screen. If the market falls 40% next year, my net worth falls 40%. In a week. Yours does not." David thinks about this. He says, "So what would you tell a 26-year-old? Marcus says, "I would tell them to buy the index fund first. The moment they have the deposit, buy the property too. Never stop adding to both. And never, not for one single month, let the debate about which one is better stop them from starting either one. Because the only investment that is guaranteed to make you poorer is the one you never made because you were waiting for the perfect answer." David writes that on the back of his notepad. He draws a line down the middle. On the left, stocks. On the right, real estate. And underneath both of them, he writes one word. Yes. Before we close tonight, here is exactly what David and Marcus agreed you should do. Depending on where you are right now, if you have under $5,000, open an index fund account today. S&P 500 or Total World Fund. Contribute whatever you can monthly. Do not touch it. Do not watch it obsessively. Just add to it consistently. If you have $5,000 to $15,000, continue building the index fund. Simultaneously start saving aggressively toward a property deposit. You are building both lanes of the highway simultaneously. If you have $15,000 or more, make a decision about your investor type. If you are type 1, fully commit to the index fund. If you are type 2 or 3, consider the property conversation with a qualified advisor. If you are type 4, index fund first, property second. Both eventually, regardless of where you are, automate everything you can. Because the biggest enemy of long-term investing is not the market. It is the month when life happens, and the contribution does not go out. Automation removes that enemy from the equation, and compound interest does the rest. Real estate or stocks. 30 years. 1.4 million versus 912,000. $500,000 gap. 1,200 hours of human life. A boiler. A tenant. A roof. A marriage under pressure. A family holiday delayed. A portfolio that grew through 2 crashes and never needed a phone call. Both built something real. Both created financial lives that most people in the world will never have. And both, here's the part that matters, could have been built by you. Starting today, with whatever you have. The debate between real estate and stocks is not the debate that matters. The debate that matters is between starting and waiting. Between investing imperfectly and not investing at all. Between building something modest today and imagining something perfect tomorrow that never arrives. David and Marcus both started at 26, with $15,000, and a decision. You have a decision. The $15,000 can come later, but the decision, that one is available right now. Before you leave tonight, 4 things. 1. Hit the like button right now if this video gave you more financial clarity than you had before you press play. The algorithm needs to know this video matters. 2. Subscribe to Finext Wealth right now. This channel is built for you, for every person who wants to understand money clearly, honestly, and with real numbers. We are here. We want you to stay. 3. Share this video with a friend who is having the real estate versus stocks debate right now. Send it to them tonight, before you go to sleep, because they need the numbers, not the opinions. And you just found the numbers. Give them to someone who needs them. 4. Drop a comment below this video. Tell us which one you are. Type 1, 2, 3, or 4. And tell us the next financial topic you want us to cover. We read every single comment. Your comment might become our next video. This channel grows because of you. Thank you for watching tonight. Genuinely, from all of us at Finext Wealth. You showed up. You stayed. You engaged with something that will genuinely change how you think about your financial future. That matters to us more than any algorithm. Welcome to Finext Wealth. We are honored that you are here.